Well, good evening, traders from around the world. My name is James. I'm here on behalf of Pivot Point Trading, bringing you a little bit of a special Monday afternoon market recap, taking a look at the 3 US indices. The reason I want to do this for you and the reason I'm doing such a second video for this evening is really because I do believe this is a very, very significant price point which we're trading at and all around really for the past week. I really mean this. What this is going to do for the market is really set the tone up for at least the intermediate movement of the market leading in and throughout 2014. What I mean by this, is the fact that we've got some incredible signals which are telling us this market is either going to go one of two ways. It's either going to break out above old resistance levels and old 2014, 2013 highs, or in fact it's going to roll over right at this price point and set up a new lower low, or in other words, set up a new bear market. For many of you out there trading the markets, you may not be familiar with the bear market. You may not have been around during the 2007, 2008, 2009 bear market, but this is eerily reminiscent of those years and those months leading into the actual trend reversal and the market reversal to the downside. Very important that you listen to this video because there are some really amazing cautionary signals being thrown out by the market, but for only sophisticated and educated traders to understand and analyze and obviously set themselves up for success. So here this morning, this evening, wherever you are around the world, let me just walk through some of the signals which we're seeing in the market, which has got me so alerted and really so cautious about trading any bullish upside potential until we break out above these old resistance levels. First of all, markets tend to cycle. All right, everything in the world and in life cycles or has different cycles. Generally with the stock market, you'll get a bullish market which will last for 3 to 5 years before you get some significant retracement or a correction in the overall market. As you can see, since the lows were established in May 2009, we've been in a very healthy bullish market. There's no question about that. However, we have not seen or actually come across a full-out bearish correction in the overall markets. Yes, we have got fan lines. Generally on the third fan line, you do get a break. However, we are quite a ways away from this extended right line coming up through here. Let me zoom in on the detail and just show you where this line comes in. This is just a projection of that third fan line coming through here. So it's not until and if we do break below this fan line as to when we should really significantly be changing our perspectives from bullish to bearish. Having said this, again, we've gone through periods of consolidation lately and we have broken out healthily to the bullish upside. We've got bullish breakouts establishing higher highs. We've got higher lows, retestings of old resistance as new support before we bounce up and make that new higher high. However, at the current juncture, we have established a lower low. And this is something that we haven't really seen since 2009. This is such an important psychological piece of trading sentiment going out in the market at the moment. This swing low is a big deal. Now you might be looking at this and saying, well, it was just a retracement, it's just a correction. Yes, it could be. However, what I should say is that it takes a lot of pressure, a lot of selling pressure to actually sell off a bull market below its previous support level. Not only a support level, but also a swing low level. What we're experiencing now in the Dow Jones Industrial Average is some form of rally, okay, or a bounce. And what we're doing is trading around this pivot point or this resistance level right here. We've still failed to break above this old resistance level. And we are also trading into the Fibonacci 0.618 retracement. That, of course, is the 61.8 retracement of this bearish sell-off. We are really struggling to break above it. And you can see by the candlesticks that we're actually seeing a lot of selling pressure coming in as it's exemplified by these long upper wicks. Very important for you to understand that. Although the candlesticks themselves, especially today's candlestick, can be interpreted quite bullishly, what I'd like to bring your attention to is the actual intraday behavior of the market itself. Within the first hour, the market was trading up here around 16,340. The candlestick was completely different. It was a completely white candlestick. It looked as if the market was off to the races again and if we were breaking out above this resistance level. However, we struggled. We moved sideways for 4 or 5 hours before ending the session, or the last 2 hours of the trading session, significantly selling off on even greater volume on which bought the actual market up in the first 1 hour of the session. You might say, well, intraday data doesn't matter, but no, you're completely wrong. It of course does. Candlesticks are the first piece of analysis which alert us to any potential reversal or trend continuation. They'll beat all of your indicating settings, and they'll also trump, of course, basic price analysis. This is really where we hone in on the sentiment. And at the moment, it's in a perfect location where selling pressure is becoming evident on increased volume. Generally, what we see is when we're testing the right shoulder or forming the right form, the right shoulder of a head and shoulders topping pattern, you see price or volume actually decline during the bounce or the rally, which I just spoke about, and you'll see it pick up at pivot points, especially when the market rolls over, if and when it does. So if this market decides to roll over, please look for volume. Please make sure it supports the trend below 15,961 before getting net short on your positions. Having said this, if the market decides to move up to 16,470, sure, it can do it, but there's no bullish trades which I am chasing out there in the market in the face of such bearish sentiment occurring. Again, you look at a lot of social media, and everyone's very excited about the bullish resumption of the rally. But when you see the overwhelming majority on that side of the fence, it's time to start sort of coming to your own conclusions and hypotheses of what might actually occur in the market and setting yourself up for success. So that's really the theme of the market, at least for this week, moving forward until the 28th or the 29th of February, whenever this trading week ends. Very, very excited to see what happens. I do think we are due for a correction. We are due for a bearish sell-off, and we've set ourselves up for that. This could entirely be what we call a whipsaw, where overly eager sort of bulls get whipsawed into all types of bullish positions, only to be found out by the market as we whipsaw and retrace and slingshot in the complete opposite direction. So that's a basic overview of the market. Again, the markets are not in agreement. You've got the Dow Jones struggling to take out old resistance and old swing highs. As you can see, we've set up for a lower high. I'll just put a LH. It's not what I do mean by that is that we've got a lower high, we've got the lower low, but if you take a look at the Nasdaq again, it's breaking out, it's broken above the old resistance anyway, established in January, and you've got the divergence occurring on the Nasdaq. If you take a look at the S&P 500, this may be the most important piece of the puzzle when we combine all three of the US indices together. During the trading session, let me just make this a little bit larger so you can see this and bring it down, if it wants to for me. There we go. What you can see is that during the trading session as well, we did have a large bullish candlestick, okay? It did look something like that. Excuse my drawing, all right? However, everyone was getting whipsawed into positions again. During the last 2 hours of the trading session, we did get strong selling pressure coming into the S&P, and yes, we did end the day with a long upper wick. Although it's not a shooting star candlestick, it is definitely telling us that the selling pressure all around these resistance levels. So what we did over the weekend is that we set our trigger all the way up here at 1,868 to avoid such an occurrence, getting us into trading positions that we did not ultimately want to be in. Now again, this story is flowing very freely, and it's coming together quite well with how we address the market over the weekend. So again, very excited to see how this market plays out. I'm remaining neutral, however, I'm skeptical of the bullish continuation and any bullish movement higher until we break out above the swing highs established in January 2014. Thank you very much for watching this webinar. Share with a friend if you got someone, or you know someone anyway, who wants to learn about the stock market, who is interested in understanding market sentiment and basic market form. Could be one of the best decisions you make in your trading career. All the best, everyone. I'll be back with you on Wednesday for a continued market update.